This is Trepp Wire Week in Review for week ending August 7th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And this week, we have with us Orest Mandzy, Managing Editor of CRE Direct News. He'll be leading us through a review of REIT performance. But first, this week, Democrats in the White House are still negotiating the details of the next stimulus bill and extending unemployment benefits, which have lapsed. The weekly jobless claims number hit its lowest point since the shutdown at about 1.2 million, but we haven't seen the total number of unemployed move much since May, around 30 million. The July jobs number comes out Friday. The number is expected to show some positive gain, but not the robust number we saw in June. With the recent surge in cases and lapse in benefits, the economic recovery is at an important pivot point, and we plan to cover some of the data that shows that. Thank you for joining us, Orest. Welcome. You and your CRE Direct News team are based in Pennsylvania, outside of Philly. As Joe likes to ask, what is the vibe there?
Well, we're in beautiful, bucolic Bucks County. If you're not familiar with it, it's where George Washington crossed the Delaware to battle the Hessians at Trenton. So kind of puts you where it is. Things are okay here. We had a little tornado yesterday, but other than that, life is slowly coming back to normal. My favorite taco stand is still in business, so things are okay.
So you had the tornado. You had a tornado. We had in the tri-state area. We had Hurricane Isaiah, which I thought was, not only do you have a hurricane. I don't think
that's how you pronounce that.
It is. It is. Look at listen to the news. That's how they do it. It's not Isaiah, but not only do you have a hurricane coming at you, you also have to figure out how to pronounce it. But anyway, I would say that all of the tri-state area is seemingly out of power. I was out of power until about late last night, and I will tell you, we should all be very, very grateful to have electricity and running water, because when you don't, it is, you forget, you take for granted how amazing these things are.
Hey, this is 2020. We're only 7+ months into the year. A lot can still happen. Keep your fingers crossed for electricity and power and gas and generators. It's still early.
Yeah, the way things are going, right?
So, Orest, you have been doing this for some 20 years. I don't want to date you, but longer than most.
Yeah. So this is my third crisis. So I started reporting on commercial real estate in 1989, covering the S&L crisis. And as you all said, there's been nothing like this, or at least not that we've lived through. And the impact on commercial real estate, while similar to previous cycles, has been sort of, well, we'll talk about the hotels in a couple of seconds, but it's been devastating to the hotel market, absolutely devastating.
So when you compare this crisis to, say, the Great Financial Crisis, which we often do when we talk to guests on our podcast, what would your answer be?
The downturn has been swift, whereas after the GFC, it was much more sort of a downward spiral, a gradual spiral. This was just, today we're alive, tomorrow we're dead. Just it was an on-off switch almost, and that's because of the shutdowns.
I would say that there's no place to hide, right? During the Great Financial Crisis, we've said this in earlier podcasts, there was real big impact on those places that had seen a housing boom. There was a big impact on those that had bet heavily on credit default swaps like AIG and others, investment banks that had become too leveraged and so forth. Wall Street had been heavily hit. People that had to tap the credit markets had pain. But if you were running a small business, a deli, a hardware store, something like that, you probably saw a downturn of sorts. But you didn't see demand go from 90 to maybe 10%. Like you did in the last 3 months. And I think that in this particular case, there's just so many more people for whom demand just completely disappeared for their services.
And there was somewhere to go, right? I mean, like, even if you were laid off from your job, you could get a job at the store, get a job at a restaurant, get a job somewhere. Like there's just nowhere to go right now. And I don't think we've ever seen it before. I think, we talked about the HOPE Act last week and the, potential bailout of the CMBS borrower. We handicapped it at less than 50% chance. I probably would say we think even more negative, slightly more negative about the prospects of it now after seeing some CREFC and MBA comments about the language. But at least they had 2, 3, 4 years to figure things out and to put together stimulus plans and to put together, a recovery. Whereas we were it was an off switch, like Orest said.
Well, the interesting thing that, kind of pulls both of your thoughts together, Orest, that this all came so quickly, and Joe talking about the various acts that are going on, and Martha talking about, a stimulus package, is that there's so much detail that there's no time to really focus on, right? People talk a lot about unemployment benefits, and is there a disincentive to work, and will people not come back to work because they're making too much money, and so forth. And that's a very valuable argument. And nothing I'm about to say is in any way a value judgment. It's just an observation that, you look at two different states that border each other, like Massachusetts and New Hampshire. Massachusetts is incredibly generous with their unemployment benefits. If you don't have dependents, you get $800 a week. If you have dependents, it's $1,200 a week. So with the extra $600, your annual take-home pay, if you will, if you were to annualize it, is about $74,000 a year, right? That's if you're single. If you're married, it's about $95,000 a year. The per annum income in Massachusetts is $75,000. So there might be truly a disincentive to go back. But right across the river in New Hampshire, where a lot of people from Boston do live in New Hampshire, the baseline is only $427 a week. So before the extra $600, it's only $22,000 a year annualized, and it gets you up to $53,000 where you add the $600 a week. So you're still about $10,000 below what the per annum average income is in New Hampshire. So even though those two states border each other, people living in New Hampshire may be much more incentivized to go back to work than those in Massachusetts. And you see things similar in Minnesota and Wisconsin, Colorado and Arizona and so forth. And so, like I said, I don't have the answer for this, and those in Congress and in the White House and so forth have tried to put these together, these programs so quickly that there hasn't been a lot of time. But the truth of the matter is that as this evolves, you will see probably very regional differences between how quickly economies bounce back based on these factors and based on how generous states are one versus another.
Yeah, well, I think I heard it on some podcast at some point. It's like any social program that you put into place is bound to have unintended consequences that you never thought of. And that includes, $600 a week versus $100 a week, or $200 a week over here and $200 a week over there, right? It's like, it's just mind-boggling the level of detail and granularity with all of this stuff. And I think the first stimulus package, it was literally wartime, and Congress said, we just have to, there's hospitals getting filled up and the economy is shut down, and if we don't get something done here, we're all getting voted out. So they all kind of work together and move something across the goal line. And I think the second one, which they're still debating now that we're kind of seeing some light at the end of the tunnel, we're seeing some reopenings, that's where we start to have these kind of political debates back and forth, and, where we're arguing over the nits and gnats of this thing. And, I don't even know where I stand on it. I think, spending all of this money kind of scares me, especially, Keegan and I are going to have to pay taxes for the next 150 years. And those taxes are going to have to be increased to pay for all this. But at the same time, when you've forced or when you've shut down business, kind of makes sense to kind of have some back pay or however you want to think about it. I mean, Con Ed, I was on their website yesterday looking at the outage map which was lighting up like a Christmas tree. So I didn't think I'd ever get power back, but luckily we did. They have a deal where if you lose food or medicine due to a power outage, you can put in a claim. And this is kind of like that, right? Like, hey, I lost out on 4 months worth of, restaurant revenue because I own a restaurant because you shut me down. Maybe there is a claim there, and a valid claim.
Well, because we've done so much stimulus and these stimuli have been so much bigger than anything we've ever done before, it reminded me of one of my earliest jobs, which was working at a bakery. I worked at a wonderful bakery out in Rocky Point, New York, a place called Tilda's. It still exists. And if you're on Long Island's North Shore, it's a wonderful bakery. But I worked there one summer, and one of my jobs was filling the cream donut, right? You had to put the cream in the cream donut. And one day the boss wasn't there, and he was always a stickler. Don't overfill the cream donuts. That's, profits going out the door. Well, we decided to fill this cream donut to the point where it was the size of a football. And we left it on the shelf waiting for some guy to come in and eat it with his hand, right? He wasn't getting a dozen, he was just getting one. And you can imagine what happened to that cream donut. And I feel that way with our economy right now. We just keep force feeding in more cream into this stimulus, and eventually something's going to explode. We just don't know what.
We just don't know what. It's whether it'll be on that guy who walked in with the beautiful suit on and just wanted to have a nice donut, and some teenager ruined his day.
There's a special place in hell for guys like me that explode cream donuts on people's
Cream donut hell?
I would say
suits.
that it is official that whoever took the over in the number of podcast episodes until you told the cream donut story, I think, because the over under was set at like 3 episodes. So you really, hammered the over on that one. I'm surprised.
He held
out.
That's right.
So
people thought it would be a drinking game, that I would mention it every single week, multiple times, and that they'd be playing it in New Haven at Yale during fall semester.
So let's look at the real estate earnings. With the earnings season, we saw some winning and losing REITs, and Orest is going to walk us through that. Most REITs specialize in property types, and hotels are the most economically sensitive. So let's talk about those first.
Yeah.
Let me, before Orest jumps in, let me just say that we talk about REITs from time to time. I utilize Orest's research all the time. It's a great resource. So if you are a REIT follower, definitely check out his website, because a lot of this stuff is really fed to us right from him. And we've been utilizing his resources for years and years.
CREnews.com, that is.
Well, thank you very much. I'm flattered. So let me paraphrase Robinson Hayes, who's the chief executive of Ashford Hospitality Trust. They're a big hotel owner. The second quarter was gut-wrenching. So we know that hotels have been clobbered because of their transient leases. Things happen, people just stop renting rooms. Owners were beaten to a pulp during the second quarter. Revenues declined by more than 90% for the hotel REITs that so far have reported their earnings. And if they're not generating revenue, they can't pay their mortgages. So let's get back to Ashford for a second. They stopped making debt service payments on $4.1 billion of mortgage debt in April. The company's managed to negotiate forbearance agreements on about $1 billion of that, and it has $275 million of liquidity on its balance sheet. But they're trying to hold on to that liquidity because even if a hotel is closed, it costs money to run it. So they're afraid that money is not going to last forever. So the REIT's looking for fresh capital as we speak. It's been it's made an effort to swap its preferred shares for common stock, which don't require payment of distributions. And because liquidity is so dear, it doesn't want to put up any equity or pay any fees or any hefty fees for to win a deferral agreement. Oftentimes, a CMBS lender or a bank lender negotiates some sort of forbearance or a deferment agreement, they'll ask for additional equity. They just don't want to do that. So they're probably going to give up more and more properties. But the special servicers don't want the properties. Instead, they're hoping that mezzanine lenders that are junior to them take action, and those lenders don't want the properties themselves.
Well, it's a very interesting dilemma for Ashford right now, because they've seen the HOPE Act they've seen the details. They know that the deal comes with a preferred equity slice, right? That's how they would get their cash.
Right.
Yet on the side of trying to raise money right now, they have to balance one versus the other. Do I tap a source that I have in the hand, or do I wait for that Hail Mary with the hopes that Congress can get this over the finish line? So it's a tricky business to be in on so many levels, dealing with the special service or harvesting cash and then trying to figure out what your best strategic options are.
Yep. Another company in the same boat is Chatham Lodging Trust. So they own a lot of limited service hotels, Courtyard by Marriott, Holiday Inn Expresses and stuff like that. I might be wrong on Holiday Inn Express. I don't think they own any of those. But in any event, 3 years ago, they bought a portfolio of 48 hotels from with North Star, which is now Colony Capital. The portfolio then was worth about $1 billion. That was in 2017, and they borrowed $780 million from the CMBS market. It securitized in a BAML 2017 CHOP deal. They wrote down their equity position to zero, and they're giving back the entire 48 property portfolio because they said the properties can't support the debt, and they're not going to pony up any additional cash. A couple other data points. Pebblebrook Hotel Trust, who owns some really nice high-end hotels like the Hotel Palomar, Beverly Hills. I've never stayed there, but I've been told that it's really nice. They might not want to invite me there. So its revenue dropped by nearly 95% to $22.5 million in the second quarter. Same quarter a year ago, they generated $442 million of revenue. Some of their hotels are still closed right now. And Host Hotels, which owns 80 properties, saw revenue drop by 94% to $61 million in the latest quarter. So where's the hotel market right now? We've seen incremental improvement in occupancy levels. It's been kind of spotty as states have pulled back on liberating their economies. So for the week ended July 25th, occupancy was 48.1%, which is a slight improvement from 47.5% a week earlier, and a substantial improvement from 22.6% at the trough in March. Folks tell us we rely on STR for real estate data, and they're of the mind that the market won't recover until about 2023. So we've got a long haul ahead of us.
So it's a very interesting conundrum that I guess the whole world faces, but especially in lodging. If you think about Ashford, Pebblebrook, Host Hotels, and these others that you've mentioned, they are experts in managing hotels, right? A special servicer in the CMBS industry is not necessarily an expert in managing a hotel. So when they are dealing with Ashford or one of these other borrowers, they're probably not thinking, we want to take the keys back here, right?
Yep.
Right. And also they know that if they do take the keys back, what type of market is there if I do take the keys back and put this up for auction, right? So it's almost reminiscent a little bit of the extend and pretend that happened last time around, except that at least last time in the GFC, there was still some business activity happening, right? So it's kind of interesting. I would think I think about Sam Zell again, or I think about, not that Warren Buffett would really ever get involved, but somebody with a ton of dry powder on the sidelines, if they were willing to take the pain for a year or two, hotels will come back. People will travel again. And business travel will come back. Maybe not to the same level as it was before, but this stuff will come back. So if you had the dry powder to be able to maintain and withstand the pain for 6 months or a year, you could probably make an absolute killing in this market.
Yeah. I think the problem we have, Don Sheets kind of alluded to this, and we had a listener ping us with his comments via email this week, is that the prospects of relief for hotel owners that's making its way through Congress is preventing there from being any price discovery, because in many cases, hotel owners are holding out for that Hail Mary pass. And I think that if that wasn't out there, I think we'd see the velocity of people throwing back the keys be even higher than it is now. But I think for most guys, if you can get a forbearance, use the FF&E to keep your loan current and kind of live to fight another day, you may as well, right? And I think that's a lot of what we're seeing right now.
A lot of the folks are saying that, special servicers are providing generally 3 months plus options for another 3 and forbearance. Each deal is unique, but that's kind of like a general statement. They argue that might not be enough. What happens after 6 months? At that point, you're breaching covenants.
So let's turn to retail. Business openings helped lift retailers who had a fighting chance prior to the shutdown, but we've seen an unprecedented number of retail bankruptcies this year. How has that impacted the retail REITs?
Awful. Now, so retail REITs are, I've divided them into kind of like 4 broad categories. So you'll take the high street retail properties, which are sort of like the ground floor of office buildings in central business districts. We could take a look at Vornado Realty Trust, for instance. They own office and retail space in New York. Its rental revenue dropped by 20%. An example of how marked the decline in value has been. A year ago, they sold a stake in a portfolio of their high street retail properties in a deal valued at $5.5 billion. They've written that value down by over 10%. And that was exclusive of COVID. That write-down occurred prior to the COVID pandemic. Their collections from the retail tenants are 72%, from office 98%. SL Green is another owner of high street retail. Even though their portfolio is largely office space, their retail collections were 70% compared to 96% for office. We go to an outlet center owner, Tanger Factory Outlet Centers. They're an owner of top tier properties. All of them were closed in April. By early June, less than half were closed. And as of the end of last month, 95% of their 39 properties were open. But their revenue has been cut in half to $64 million. Here are the interesting data points. 43% of rents were collected. It's deferred 26% of rents and written down 25% of their rents due. And that we'll probably see the same thing with other mall owners. Those guys haven't reported yet, the folks like Taubman, Simon, Macerich, Urban Edge, but you can probably use Tanger as a proxy for those. And now we move to neighborhood shopping centers. An example of that is Brixmor Property Group. They own 400 properties. A lot of them are anchored by grocers, and those grocers are sort of providing them the blood that they need to stay in existence. Revenue dropped only 15% in the latest quarter. Rent collections were 77%, and they've deferred about 10% of the rents due, and they've granted about $1 million of rent abatements. And then we go to the net lease sector, a Realty Income Corp, which is kind of like the blue chip company. You could argue the blue chip retail REIT company. It did quite well. It owns 6,600 properties occupied by tenants including Walgreens, 7-Eleven, Dollar General, FedEx. Collections were 92% of rents due last month. For the second quarter, they were 86.5%. So there you have 4 different types of REITs that own different types of retail properties. They're all suffering, but not at the same levels. They're all different, all over the board.
So if we were to rank them from best to worst, it would be the triple net lease, I'd say high-end outlet, or no, sorry, it would be triple net lease, grocer anchored, right, high-end outlet, and then shopping center, right? Or mall. That's right. Yeah, which makes sense, right? That kind of, it's nice to see the real data flesh out, what you would expect to see.
And then there's differentiation among the net lease REITs, net lease owners. It depends on your tenants. Mm-hmm. Realty Income happens to have tenants that are pretty stable, triple B plus and uprated.
And probably tenants that were allowed to remain open.
A lot of them, yes.
Right? Pharmacies and CVS and Walgreens and stuff like that.
That's right.
So let's look at multifamily. You have said, Orest, that this sector has been one of the most resilient historically, but somehow that's changed.
So the whole story hasn't been told yet because a lot of that hinges on government subsidies. People have been getting that extra $600 a week, allowing them to pay rents, and they've been paying rents. So most of the public REITs that own apartment properties own Class B or better apartment properties. So the data on that is very easy to collect. A lot of people compile it and stuff. So what we have, let's take a couple of companies, for instance. EQR, Equity Residential, owns properties in major gateway markets. They saw a 9% decline in lease rates after concessions are factored in. Occupancy in their core urban areas have declined as people have moved out because of the pandemic. And as companies like Google and Amazon increasingly allow people to work from home, they're opting not to work near their employers and maybe moving home or whatever the case might have been. Another company is Avalon Bay, which, like EQR, has a concentration of Class A properties in urban locations, saw a 3% decline in 2Q revenue. EQR is 2.4%. Rents dropped by 5.1% in Southern California, 5.2% in New York, and 2.2% in the Mid-Atlantic region. I recently spoke with the folks over at Fannie Mae, and they've told me I haven't been able to get the data on this, but the picture in the Class C market, public REITs don't own those types of properties, is probably a lot worse than it is in the Class A market, because you tend to have a lot more hourly workers occupying those properties. Those will suffer the most in the event we don't have another government bailout coming up soon.
Yeah, I think that you will see a big correlation. This is just me predicting, between the percentage that people pay in rent as a function of their overall income and the level of defaults we see. So it'll be kind of barbelled. Like you say, the people that don't make a lot, right, even if their rent is relatively small, we'll see high defaults, because even though the rent is low, it makes up a big part of what they earn. But I do think that you'll see a similar effect in 24-hour cities where the rent is so high that, for a, junior analyst at a bank that maybe starts out at $60,000 a year or something like that, if you're paying $2,000 a month or $3,000 a month, that's hard to sustain if you're not going to the office every day. And even more so if the bar at the end of the corner doesn't have the karaoke on Thursday night. So it's, two strikes against you. So I kind of have the instinct that this will be barbelled when the next couple of chapters are written, when this plays out in December and January.
And just by looking at some of these numbers, Orest, the revenue declines were pretty small, right? 2-3%. Year
for the
over year,
apartment REITs, yeah, that's
for
right.
the apartment REITs. But what the other numbers that you're quoting would indicate that those revenue declines might be larger in future quarters, because their occupancy is declining and their new lease rates are also declining, right? So we'd expect to see somewhat more of a drop over the next couple of quarters, unless something drastically changes.
Yeah, that's right. That's right.
And while it's a separate data point, we put out a report on GSE lenders, and we looked at what they were doing in terms of forbearances. So what did that show, Joe?
Yeah, so I should have caught that segue, Martha. I apologize for that. Your background at Steel City Dave's amazing abode is just distracting me. Same with Orest's. This is bad radio, but Orest has a background full of toilet paper. I think he stocked up a couple of months ago. He's a big arbitrage guy.
He likes using the Costco Wi-Fi. Cheaper and more plentiful.
So shop in stores with concrete floors. Remember that. Yeah. So this GSE, we've been tracking the forbearances, ever since this whole thing began. And I think the Fannie Mae reporting has been pretty good. They've been coming out with a list of loans that had executed forbearances every week, an updated list. Freddie Mac has been a little bit not tougher, but it comes through the regular investor reporting package channel data wise. So we have to capture the modification codes, the special servicer codes, the watch list codes, and the watch list or special servicer commentary to really, capture if the forbearance actually has occurred yet or not. But I think, the moral of the story was that there are billions of dollars in forbearances already executed and more to come. I wonder, I think FHFA recently came out with a pronouncement that said, if you are a borrower and you are taking advantage of one of these forbearance programs, there are new rules about disclosures you have to make to tenants. So I think the point of that is, if you take advantage of a forbearance, you can't be evicting your tenants. So, it'll be interesting to see how that all kind of develops. And also, right when these forbearances end, which will be, this month, the month after, and the month after, and kind of a rolling time period going forward, who are you replacing? If you have 10 or 15% of the tenants that are not paying, like Orest is talking about, they're blue collar hourly workers, and maybe the stimulus bill now is only giving you an extra 100 a week instead of 600, and restaurants really aren't opening up at full speed yet, or other areas. Do you evict people in this environment? I'm not sure, because who do you replace them with? Like every other similar type person who would be looking at a similar type apartment is probably in a similar situation. So I really don't know how long we can kick the can down the road, but it seems like, FHFA is hoping to kick the can until we can kind of come out of this.
So let's turn to mortgage REITs.
They went through a hard time, but it seems like they've basically, for the most part, they've survived, and they've come out of this much stronger than they were coming into it. So most mortgage REITs that we track, and we only track them if they invest in commercial real estate. So they'll originate loans, and excess cash they'll invest in CMBS, and they'll do a bunch of other things. But those are the two primary asset classes that they're investing in. They invest in CMBS and leverage their investments with repurchase agreements. Those repo agreements are always subject to margin calls. So if the value of the collateral declines, you got to pony up more cash. Every single mortgage REIT got hammered after COVID, when the CMBS market went topsy-turvy. But things have sort of normalized a little bit. In fact, a CMBS deal that priced a couple of weeks ago was actually profitable. It generated about 5.5%, a margin of about 5.5% for the lenders. So one of the big mortgage REITs is Ladder Capital. They're they're among the most transparent mortgage REITs, so it's easy to get a lot of data on them. It hasn't received the margin call since May 5th. That's an indication that the value of the CMBS that it carried as collateral to its repo agreements has increased, and it has a ton of cash. It's got more than $850 million on its balance sheet. But cash on your balance sheet doesn't generate the income you need to pay dividends to your shareholders. So they're waiting for opportunities to invest that cash. Right now, they believe that the opportunity is conduit lending. So we'll probably see that take off pretty soon, given the profitability of the last couple of deals that hit the market.
Yeah, the curtailing of the margin calls probably went hand in hand with the Fed starting to buy paper. That led to a big compression in spreads. The compression in spreads helped prices firm up, and that probably had a lot to do with the end of that kind of run on the REITs. So, we kind of saw the benefit of the Fed buying program back in 2008. That added liquidity to the market, and it also led to a huge spread contraction that happened again this time as well. And it seems like that benefited the REITs, the mortgage REITs, that is, to some degree.
Right. And another kind of an interesting little data point. So all the mortgage REITs, they rely on churn. They're writing short-term loans, and they're constantly getting repayments, and they've got to put that cash out again. They're getting repayments, but they're not putting that money into new loans because there's no demand. It's not that they don't want to, there's just no borrower demand, which is kind of an interesting dynamic right now, given that interest rates are so low.
Yeah, well, we have a lot of, I have a lot of friends at the mortgage REITs, and just a couple of themes about how they work and, how it relates to COVID times. I mean, they are, it's a very different world than, a CMBS loan. They have, 60 or 100 or 150 loans on their books, and they actively asset manage every one of them. They have, tight relationships with all the sponsors and the borrowers. They've probably done several deals with them over the years. So, when something like this happens, they have the ability to go in, re-underwrite every deal, revalue every property, have a conversation with every borrower and sponsor, potentially restructure the loans that they have to restructure and extend, cut some slack, let them tap reserves, like all that flexibility that doesn't really exist for the CMBS borrower. It does for these borrowers. We've heard that same kind of anecdotal evidence of, we're just shoring up our cash position, where we're looking to put money to work, but we're not in a rush to put money to work. And if you think about it from the borrower perspective, most of the time, the type of deals they're doing are transitional, which means, not necessarily income producing, but, a borrower is going to buy an apartment building and convert it to condos, or they're going to buy an office building that's 50% occupied and, do some TI and, redo the building and try to lease it back up. And the loan's 2 or 3 years and they have to execute on their business plan to do it. So if you're looking at a project like that right now, you have no idea what your exit value is going to be, right? On any property type, especially, office, retail, lodging. On that note, I'll give a shout out to Tommy C from Queens. He was in Midtown Manhattan today, and he sent me a picture of our old office building, 477 Madison, which I think RFR owns, and they did a big, rehab, new windows, the HGTV gray paint. It's the old white wedding cake looking building. Now it looks a little bit more modern. So hopefully they redid our Gordon Gekko 1980s offices too. But on a totally tangent note, Tommy also told me that it is a scary place in Midtown Manhattan right now. It's very weird. There aren't many, as you would say, normal folks out on the streets right now. So I don't know if I hope that we can get back there, right? Because there's no way we can kind of reinvigorate the city without starting. So anyway,
that's a perfect. No, it's a perfect segue to talk about office REITs, because working remotely is clearly going to impact that sector. So let's do that.
And Bucks County, Pennsylvania has about a 25% vacancy rate. I'm just putting it out there.
In office?
Yes, in office.
Okay, all right.
It's a lovely
when
country.
You talk about that,
we can do a podcast studio out there.
Barron's had a great office REIT piece this past Saturday, and by Lawrence Strauss, and he was saying that even though the Philly suburbs occupancy may be 75% as reported, it's really only 5 to 10% physical. So people are paying rent and they have 75% occupancy, but the number of people in that market actually going to the office is 5 to 10%. And a couple other data points from that same piece: in Austin, Texas, 10%, Washington, D.C., 20%. So it just goes to show, outside of New York, which was clearly the most painfully hit tri-state area when it came to COVID deaths and the length of time that it has been shut down, the shadow vacancy has just been enormous everywhere.
Right. In New York as well. My cousin's properties, for instance, said that its portfolio is only 15% physically occupied right now, but it expects that to increase after Labor Day. But they said it all depends on whether school's open or not. If schools don't open, folks aren't going to come to the office because they have to babysit. But the good thing for office developers, though, is construction costs have come down substantially because nobody's building. That's, I guess, the silver lining to that cloud. But you had mentioned the Philadelphia suburbs, Brandywine, which owns a lot of real estate there, and in Austin and DC. Overall, its occupancy rate is about 91%. Its rental revenue declined, though, because a drop in parking revenue. And we're going to see that with a lot of other REITs as well.
So for people that are looking for benchmarks when it comes to how much of a fall off there could be in per square foot lease rates, that same Barron's piece sourced CBRE and Morgan Stanley, and they showed the fall off in 1990, 2001, and the Great Financial Crisis. Overall in the U.S., 1990, lease rates down 9%. In 2001, after the dot-com collapse, 21% down. Great financial crisis, down 18%. For New York, those 3 points, minus 14%, minus 22%, minus 21%. San Francisco, minus 14% in 1990, minus 48% after the dot-com boom, minus 29% after the great financial crisis. So, if you're looking for benchmarks for other hard times we've gone through, and I happen to think that this will be a harder time before we're all said and done, those were some meaningful benchmarks that you could use to start building your default models.
It's funny you mentioned this. Our advisory group right now is working on a couple of engagements where we are creating value loss indexes for people with portfolios of properties looking to figure out where the heck their values are. And we're doing a little bit of that type of analysis where we look back at prior periods and use that as a benchmark, right? In 2000, from 07 to 10, we saw NOIs drop by 20% in this geography, in this property type, et cetera. So, we're also throwing in some, more COVID related adjustments and things like that. But it's definitely useful to look back when you have really no current data points to be using. You have to look back at other, I can't even call it similar, but other times of distress.
So when you're doing that, are you factoring in the fact that a lot of office users expect to increase the amount of space they allocate per employee? A lot of REITs are saying that they don't expect demand to decline that much because they think that tenants are going to increase square foot per person.
I hope for the industry's sake, I hope that that's true, but I don't believe it. So I think, we're in something in the kind of, that's my opinion, right? In the kind of advisory work we do, we present a broad range of potential scenarios and let kind of the client figure out which scenario they think is the most realistic. But for me, honestly, I don't think most companies are going to go back 100%. And if they go back at 50%, maybe they need a little bit more square footage per employee, but I have to think most companies are seeing this as an opportunity to cut costs.
On the other side of that argument, New York City, which I'm not terribly bullish on for several reasons. I think that it has been hit by everything you possibly can when you talk about business travel and European travel, Far East travel, US vacation travel, and so forth. It's really been hammered. But it got 3 really big votes of confidence this week, in my opinion. We had Facebook, 730,000 square feet of space that they're taking from Vornado near Penn Station. That's been long rumored. But, when something like this happens, there's always that chance that Facebook walks away. The fact that this thing is moving forward is a great vote of confidence for New York. IBM came out last week and said they're looking to consolidate all of their New York City offices. They want 500,000 square feet. They have 6 offices under consideration, including One Madison, which is kind of the Union Square part of town. And then lastly, Blackstone, I believe, I can't read my own notes, has been asking for proposals for 1 million square feet in either Midtown or Hudson Yards / Midtown West. So when you're asking for that kind of amount of space, clearly you're not going for the hub and spike mode model. You're really making a bet on New York City, and you're kind of dismissing all this recency bias. You said, we're going to get back to where we were 2 years ago, and we're going to take advantage of lower pricing now and lock in and bet on the Big Apple going forward.
Blackstone needs all that office space to store your saliva samples.
From Ancestry.com.
Right.
That's right. They're buy this week of that
genealogy and DNA firm.
Yeah, you took it right out of my mouth.
Well, I saw a great article, or not an article. I saw a funny meme, I should say. Let me be a millennial for a second here. I saw a funny meme that said, it's Blackstone's really taking their recruitment seriously now. They're going to be mapping your genome when you're in kindergarten to see if you're going to be a great investment banking analyst.
All right, we're
No
ready. We're ready for the shout outs for this week. We've got a few.
Yes, this is a gratitude to some of our listeners out there. We like to do this once a week. First up, AG, also known as the Southern California Hat Woman. We grateful for her listening every week and for her commentary and her questions and her feedback. DP from the Badger State, thank you for your listenership and your kind remarks. Want to give a shout out to Professor David Walker. I hope he's not listening because he retired last week. I hope he's in an RV somewhere going to the Grand Canyon or some other place which is safe these days. Congratulations on a long and illustrious career at Georgetown. He's along with being a Georgetown professor, a huge Hoya Hoops fan, something that we won't hold against him. He was responsible for backtesting Trepp's capital adequacy stress testing models, which we developed during the Great Financial Crisis to help banks meet the Dodd-Frank stress testing models. Great guy. Spent a lot of time with him watching Big East basketball over the years, and we wish him all the best. It was a pleasure working with him all these years.
And of course, Steel City Dave.
I was going to say, we would be remiss if we didn't mention Steel City Dave. He's a partial sponsor for today's podcast.
That's
so
right.
Thank you for that, Dave. And now we like to feature the deal of the week. So what do we have this week?
The deal of the week this week. Something old, something new, something borrowed, and something Eden Prairie, Minnesota. You probably thought I was going to say Bloomington. The JLL team, led by Senior Managing Director Doug Opalka, along with Chris McAlpin and Alistair Barnes, arranged a new $26.6 million acquisition loan for 13625 and 13675 Technology Drive in Eden Prairie. The new part of this, not only is it a new borrowing, but it will be in a new Morgan Stanley CMBS deal. That this was a new loan made for securitization is a positive for the CMBS market. We hadn't seen much of that in April, May, and June. This loan now will go into a new deal, which is terrific that market is coming back. The old is a $30.9 million CMBS loan that should now get defeased. Hopefully it shows up as defeased in August. This loan is part of CMBX 6, so it's a positive for CMBX 6 longs. The collateral was or is a 475,000 square foot fully occupied office in Eden Prairie. United Healthcare is the sole tenant on a lease that runs through 2023. So lots of good news on that all around.
Last week, we published the July delinquency numbers for CMBS, but we know that delinquency is really only part of the picture. So we've done some research that uncovered some information. What was that?
So we've been asked this question many times, how many forbearances have been granted? CREFC and the special servicers and servicers really changed their templates very quickly to put out a lot of new data to reflect what had been foreborn. Unfortunately, not a lot of the data had been flowing through yet. It probably had a lot to do with servicing systems not being ready to handle this, which is not a criticism of these guys. It's more a fact of that everybody was trying to pull together everything so quickly. So we did go through about 8,000 to 10,000 special servicer comments and watch list comments over the last couple of days to kind of give a real sense of what we were seeing. We believe there's about 17 billion in loans that have been granted relief at this point. If you were to take those and consider those delinquent, you'd probably see a delinquency number that was more like 11% now rather than the 9.6% that we published last week. Some of the findings we found: about 2/3 of the forbearances granted thus far are for hotel loans. That number is similar for both loan count and loan balance. 25% of the forbearances are retail loans. About 5% are mixed use, which is often office with a street level retail component. very, very small smatterings of industrial, multifamily, or office. Sometimes you get details on how this was done, whether it was a consent agreement, side letter, standstill agreement, but more often than not, it just says, the notes just say that the forbearance or the relief was granted. 26 of the loans had balances of 100 million or more, and about 250 loans had balances of 25 million or less. Orest had talked about some of these before with regard to Ashford, but we did see, just to mention one or two others, the $600 million Grand Lakes portfolio loan backed by 2 Orlando hotels, one a Marriott, one a Ritz-Carlton. They got, for example, a relief letter to allow them to use the FF&E reserves to keep the debt service current. That was indicative of the kind of things we were seeing.
Well, I just want to clarify, Manus, two things. Always two things. When you say we went through 8,000 to 10,000 comments, is that the royal we? It means you went through 8,000 to 10,000 comments?
Well, it's one of
I know
those
you don't want to
situations.
admit it. I know you don't want to admit it.
He has
It
a
was
research
you.
team. He has a research team.
Luckily, you had power for the last couple of days.
This was called fun
Luckily,
things to
I
do.
didn't.
Fun things to do during a hurricane, right? When there's when the Rangers are getting eliminated from the playoffs and the Mets lose 6 in a row, you're looking for other ways. They're even less painful than those two things. And what less painful for me was reading through 8,000 watch list notes.
So as someone who still uses the DOS prompt, I know that you were going through those manually. So, good on you. We have a few clients who actually take this data, straight into their internal systems, and they'll build out, different types of machine learning algorithms to try and capture, sentiment scores of how properties are performing. This would have been a pretty, not simple, but it would have been an exercise in, searching for specific words and searching for specific phrases to figure out if you can classify things. So I know that we recently released or are about to release kind of an indicator of whether these comments are changing significantly, because every month you'll see a comment on the same loan and it'll be the same exact words, and you'll think it changed because, a sentence got moved around, but none of the actual, meat of the argument changed. So that's always kind of a pain in the butt of, CMBS surveillance analysts. So that's something we're trying to help out with. Just wanted to put a little shameless plug in for that.
Yeah, I mean, the going through this as well, you found a lot of evidence of borrowers willing to throw in the towel. I believe that Orest spoke earlier before about that BX deal, the Club Quarters hotel portfolio, the $273 million single borrower deal. The borrower is attempting to transition the properties back to the mezz lender, but the mezz lender is currently marketing the mezz note. So this is an example of the mezz lender has an option to take over the property, but looks like they're going to opt out in return for selling that mezz note to give somebody else the opportunity to do so. Another example was the Doubletree Houston Intercontinental Airport loan, which makes up almost 5% of a 2016 deal. Again, this was turned up in the notes as the borrower requesting a transition of the asset to the lender. So